Hello everyone, welcome back to Learn Oikonomia. In this video, we'll be covering the methods for redemption of public debt. I hope you have gone through my previous video which deal with the meaning of public debt, its causes and classification. If you haven't watched that particular video, please go and watch that video because that is very important to have a very crisp and clear idea about public debt, its causes and classification. So, in this video, we will be covering the methods for redeeming public debt. Having said that, it's very important to understand the meaning of redemption. So, what do you mean by redemption? The word redemption has been used by various fields of economics, especially in the arena of finance, business, etc. The word redemption has been used. Now, how it is defined, how redemption is defined depends upon the context in which the word redemption is used. We have said that it's used in diverse arenas of economics. Now, when it comes to the case of finance or public finance, redemption actually describes the repayment of any money, market, fixed income security. That is repayment of loans. That is what it's all about when it comes to public finance. Here investors actually they make redemption by selling a part of their investment or by selling all of their investments such as shares, bonds, mutual funds, etc. Now coming to the case of business or marketing, consumers they often redeem coupons and gift cards for products and services. So having discussed the meaning of redemption, let's discuss various methods used by the government to redeem their public debt. So what are the various methods used by the government to repay their loans? This is what we are going to cover in this video. Okay, there are several methods used by the government to deal with this. The first thing is refunding. Refunding is actually a method which is used by the government by issuing new bonds for raising new loans in order to pay off the mature loans. That is, suppose that the government has taken a loan long back, okay, and the maturity date of the loan is nearing. In that case, if the government is not able to finance this loan from its revenue, then it will take new loan to finance it, to repay its old loan. That is the case of refunding. So the government take a fresh loan in order to repay the old debt. That is the case of refunding. Okay. Now the government uses this method of refunding, and when there is no liquidation of money burden of the public debt. Instead, public debt servicing burden gets accumulated on the account of postponement of their repayments to some future dates. Because you know that when you have one loan, to repay this loan you go for next loan, and to repay the second loan you go for the third loan, and to repay the third loan you go for the fourth loan, and this will go on continuously, and this will definitely create a debt trap for the government, and this is not a good option for development, because the debt of the government will continuously increase and making the government to face a financial crunch or financial crisis in the future date. So refunding is not a good option. Now, what is budgetary surplus? Budgetary surplus is considered to be another method used by the government to redeem its public debt. Here we could see that sometimes a government is able to generate surplus in the budget, whereas in some other cases the government is making a deficit in the budget. Now, taking the first case, when the government is able to make a surplus in the budget, this situation is known as budgetary surplus. That is, this surplus is used by the government to repay its loans. In such a situation, the government is left with two options. It can either reduce its taxes or repay some of this old debt, or these are the two options. So anyway, the government has got surplus, right? Now either the government can reduce the burden of the people by reducing the taxes, so that the people will be forced to pay only less tax. No, they are not forced to pay more tax. So that will definitely act as a relief to the citizens of the country, or it can repay some of its old debt. So it depends upon the stand taken by the government whether the government goes for reduction of taxes or whether it goes for repayment of its old debt. In general, the government makes use of the budgetary surplus to buy back from the market its own bonds and securities. That means the government uses budgetary surplus to deal with its old debt. So as a result, there is an automatic liquidation of debt liability of the government. Okay. Now, the third method is that terminal annuity. What does terminal annuity mean? Here, we could see that in some countries, the government follows a practice of paying off its debt on the basis of terminal annuity. This method means that the government pays off its debt in equal annual installments. We know that if you are going to insurance market and if you buy some insurance, you will be made to pay premium, right? And if you go to the bank to take loans, you will be forced to pay interest, right? So in whether it is, or if it is, if you are taking some vehicle or something out of a loan, you will be paying some kind of interest or installments or something. You will be, if you are buying some any kind of product from the market out of EMI and all, you will be paying the amount in installments, right? So the same thing happens in the case of terminal annuity. If the government is using terminal annuity, then the government pays off its debt in equal annual installments. Each and every year, the government pay a fixed amount or fixed installment to the entity which offer money to the government, or from which to the entity which has given money to the government, or to the entity from which the government has borrowed money. Okay, and this method often finds favor with the planners and policymakers in the developing countries like India, because it leads to a fall in the burden of public debt every year, because every year it is the government is paying a portion of the debt. It could pay off a portion of the debt. So by every year, so with the passing of years, the amount of debt will come down, because the government is paying off the debt annually. A portion of the debt is paid off annually. Every year they are paying off the debt. Now, as a result, the total debt of the government would come down. The government here is not required to repay the entire debt at a time. Because this is something that is not required to make a huge lump sum payment in order to repay the debt. Now, sinking fund approach, what does it mean? Here, the government of a country establishes a separate fund known as a sinking fund just for the purpose of repaying the debt, or just for the purpose of repaying the debt. This sinking fund is maintained. So it is the money which is invested in the sinking fund is not taken for any other uses. It is just used for paying off the old debt. Under this system, the government goes on crediting a fixed amount of money to this fund every year. Okay. By the time the debt matures, sufficient money gets accumulated in the fund so as to enable the government to repay the debt along with the interest. So the government has taken the loan. So the government has a calculation of the interest rate which it has to give to the entity from which it has borrowed the money. So with this calculation, the government will be making some kind of the government will be setting apart the money which is to be paid on maturity to repay the old debt. So for that, the government creates a fund which is known as a sinking fund. Okay, in general, there are in fact two alternative ways of crediting sums to this fund. The usual procedure is that the government will deposit a certain fixed percentage of its annual income to this fund. And preferable alternative for the government is to raise a new loan and credit the proceeds to the sinking fund. So these are the two options available to the government. The government can either deposit a certain fixed percentage of its annual income to the sinking fund, or it can go for a new loan and credit the proceeds to the sinking fund. However, some economists do not treat the second method with favor. This is not good, right? We have seen that so in order to repay the first loan, going for the second loan, and going for to repay the second loan, going for the third loan, and so on. This is not a good idea to be promoted, especially a developing country is concerned. Now, if you take the example, we could see that Dalton is a famous economist, especially with respect to public finance. He has opinion that the tightness of thing to accumulate the sinking fund out of the current revenue of the government, not out of new loan, right? Now, modern economists like Richard Musgrave and others look at the sinking fund method as a systematic method of debt repayment. Under the system, the burden of debt is spread evenly over an extended period of time. But it could be 10 years, it could be 15 years, it could be 20 years. Depends upon the kind of how much the government has invested in the sinking fund in order to pay both the principal amount and the interest. Okay. Now, this normal method adds to the creditworthiness of the government, and critics however argue that this method is a slow process of debt repayment. We know that annually the government repay a portion of the debt to the person who have credited the money to the government, but the creditworthiness of the government is something that could be trusted under this approach. The government creates a new fund which is known as a sinking fund. The government invests money into this fund and so as to repay its all loans. So this is something that will act as a matter which will increase the creditworthiness of the government. Though this sinking fund is considered to be a slow process of debt repayment or debt redemption. Okay. Now coming to another method which is known as a debt conversion. Here a high interest debt is converted into a low interest one. How is this possible and when is it possible? Let us suppose that the government contracts a debt with the existing rate of interest which is quite high. But after some time the market rate of interest may fall. This is a possibility, right? Market interest may fall or it can be high. So it can either go down or it can go up. So it is not under our control, right? So it is not controlled by the government. So as a result, this gives the government an opportunity to convert its high interest debt into a low interest one. And the government is enabled to reduce the burden of public debt. From a high interest debt, it could come to a low interest debt. If the interest burden of the public debt falls on the government, is not required to raise huge revenue through taxes to the service the debt. Now, here, instead the government can reduce taxes and provide relief to the taxpayers in the event of a fall in the rate of interest payable on public debt. Since most taxpayers are poor people and bondholders are rich, some debt conversion is likely to improve the pattern of income distribution. If this happens, there is an automatic reduction in the degree of inequality in the distribution. Now, the next method is statutory reduction in the rate of interest. Here, we could see that sometimes the government passes some ordinances in order to reduce the rate of interest payable on its debt. This happens when the government suffers from financial crisis or financial crunch and when there is a huge deficit in its budget. So there can be many instances of such compulsory reduction in the rate of interest. But this practice is not followed under normal circumstances. It is mainly followed during the period of financial crisis or financial crunch. Instead, the government is forced to adopt the method of debt management only when the situation so demands, right? So that means that normally the government doesn't follow this kind of a statutory reduction in the rate of interest only when there is a huge deficit and the government has lost all other alternatives and all other options to redeem its debt. Then only the government will go to this particular option of statutory reduction in rate of interest. Now, the next method is that imposing additional taxes. This is one of another method used by the government to redeem its public debt. Sometimes the government imposes additional taxes on the people to pay its public debt. By levying additional taxes or by levying new taxes, both direct and taxes means there are two types of taxes, direct and indirect. So it can either increase direct tax or it can either increase indirect tax or it can impose some new kind of either direct or indirect taxes or both direct and indirect taxes in new forms can be imposed by the government. So this will help the government to collect the necessary revenue so as to enable to pay off its old debt. But this method is often criticized on the ground that it creates inequality in the distribution of income by redistributing income from the taxpayers to the bondholders. We have seen that the bondholders are rich, but taxpayers cannot be, all the taxpayers cannot be considered to be rich. There are poor people too who are taxpayers. So this is a main thing, or this is the main reason why it is said that if income tax revenue is used to pay interest on public debt, then there is a net burden on the community. The next method is capital levy. Here, at the times of war or emergency and all, most of the government follow usual practice of repaying its debt by imposing capital levy on its citizen. Keynes also agreed to this method, or he also supported this method when he discussed the different methods of paying for a war. Capital levy is just like a wealth tax, which is imposed on the capital assets. This method is used for two purposes, or this method is considered to serve two purposes. One is that it enables the government to repay its wartime debt by collecting additional tax revenue from the rich people. Secondly, such kind of method impose a progressive tax in capital assets which also helps to reduce the degree of inequality in the distribution of income as well as wealth. Now, third thing is that trade surplus. Trade surplus is also another method. Trade surplus, you know, right? Trade surplus means we are exporting more and we are importing less. In this situation, the surplus that we have received as a result of more exports is used to finance our old debt. When the government borrows from other countries, it has to serve the debt in foreign exchange, right? The burden of a country's external debt is measured by its debt service ratio, which is a country's repayment obligation of principal and interest for a particular year on its external debt as a percentage of its exports of goods or services or both in a particular year. And external debt usually repaid in foreign currencies or gold. So if you have taken a debt from IMF, you won't be able to repay them back in rupees. You will have to repay the IMF in the form of either foreign currencies, that too in accepted standards like dollars and all, or you can repay them in terms of gold. If a country is unable to repay the debt, then it has to export goods abroad. For this, it has to generate an export surplus. It has to raise exports and reduce imports and make net export or balance of trade favorable. How can we make balance of payment favorable, balance of trade favorable? So when I say balance of trade, it deals with both exports and imports only. We are not dealing with the services, export and import services, that we are not dealing with. When we say balance of trade, we are dealing with only goods, exports and imports of goods only. So we have to make it sure that our exports of goods is more than our imports of goods. Then only we could make our balance of trade favorable and we could generate a trade surplus. If a country is able to generate export surplus or balance of trade surplus, then it will be net inflow. There will be some kind of net inflow of foreign exchange to the country, because you are gaining your products, your domestic products, you are able to sell to the foreign country and you will be getting foreign exchange. Then you could repay your debt. That's it. This will enable the debtor country to repay its external foreign trade. Now, in this context, the following quote from Samuelson and Northus is very important. They say that an external debt, one owed by the nation to foreigners, does involve a subtraction from the goods and services available to people in the debtor nation. Many nations in the 1980s, Poland, Brazil and Mexico, labored under severe economic hardship after they incurred large external debts. They were forced to export more than they imported to run trade surpluses in order to service their external debts, that is, to pay the interest and the principal on their past borrowings. In fact, in the mid 1980s, some countries needed to pay 25% or to 35% of their export earnings to service their external debt. The debt service burden on an external debt leads to a loss of social welfare because it reduces society's consumption possibilities. So with that, we end this video. Please like, share and subscribe this channel for more videos. Thank you.